Good day everyone, this is Christy Quijano, reporter of Finance and Accounting. But before that, let me tell you something about finance and accounting. Finance refers to the way in which a person or organization generates and uses capital. This often encompasses activities such as investing, borrowing, lending, budgeting, and forecasting. And about the accounting is, on the other hand, it is refers to the process of reporting and communicating financial information about an individual business or organization. Importance of finance and accounting. Number one is financial condition is often considered the single best measure of a firm's competitive position and overall attractiveness to investor. Determining an organizational financial strength and weaknesses is essential to formulating strategies effectively. It is important to determine an organization's financial strength and weaknesses because it is essential to formulating strategies effectively. Measuring an organization's strength is an effective way to formulate business strategies. Capitalizing on existing strength includes realizing the value of human capital, developing staff and planning workforce models based on employee competencies as well as their capabilities. In weaknesses also, taking action to identify your company weaknesses can thwart competitors. Attempts to exploit them, which in and of itself is a strategic decision. Early detection of internal weaknesses gives your organization the opportunity to address and correct system flaws that impede the company's progress and productivity. A firm's liquidity, leverage, working capital, profitability, asset utilization, cash flow, and equity can eliminate some strategies as being feasible alternatives. Why? Because in a firm's liquidity or a company's liquidity, it indicates its ability to pay debt obligations or current liabilities without having to raise external capital or take out loans. High liquidity means that a company can easily meet its short-term debts, while low liquidity implies the opposite and that a company could immediately face bankruptcy. In working capital, why it is also important. It is also called net working capital. It represents the difference between a company's current assets and current liabilities. For example, say a company has 100,000 of current assets and 30,000 of current liabilities. The company is therefore said to have a 70,000 of working capital. Finance accounting functions. According to James Van Home, the functions of finance accounting comprise three dimensions: the investment decision, the financing decision, and the dividend decision. Final ratio analysis is the most widely used method for determining an organization's strengths and weaknesses in this area. The investment decisions, also called capital budgeting, is the allocation and reallocations of capital and resource products, assets, and divisions of organization. Why is an investment decision is important? It is because in organization, investment decisions are crucial for growth and profitability. In fact, cash flows have a long-term impact as many of these decisions are irreversible. Even with limited funds, individuals can obtain impressive returns if the investment is well planned. The financing decisions determines the best capital structure for the firm and includes examining various methods by which the firm can raise capital. It must consider both short-term or long-term needs for working capital. Dividend decisions concerns issues such as the percentage of earnings paid to stockholders, the stability of dividend paid for over time, and the repurchase or issuance of stock. The benefits of paying dividends to investors must be balanced against the benefits of internally retaining funds. 5. Dividends are sometimes paid out when funds could be better reinvested in the business. Most companies have ceased cutting and instead are raising their dividends payout. Financial ratios are computed from an organization's income statement and balance sheet. Why? Because they are used to get insights and important information on the company's performance, profitability, and financial health common. Why it is computing financial ratio is like taking a picture? Because the results reflect a situation at just one point in time. This is because the basis of all ratio analysis is the accounting information represented in the financial statement. Why it is comparing ratios over time and to industry average is more likely to result in meaningful statistics. The average is revenue growth allows a company to track its growth. Comparing this against the industry average is important to help a company determine if it meets or exceeds the growth rate for those in the same business. Trend analysis is a technique that incorporates both the time and industry average dimension in financial ratios. It is because trend analysis tries to predict a trend, such as bull market run, and then ride the trend until the data suggests a trend reversal, such as bull to bear market. Trend analysis is based on the idea that what happened in the past gives traders an idea of what will happen in the future. Trend analysis also focuses on three typical time horizons: short, intermediate, and long term. Financial ratios can be classified into 5 types. Liquidity ratio measures a firm's ability to meet maturing short-term obligations. Current ratio, quick asset test ratio. And leverage ratios measure the extent to which a firm has been financed by debt. Debt to local asset ratio, debt to equity ratio, long-term debt to equity ratio, times interest earned coverage ratio. Activity ratios measures how effective a firm is using its resources. Inventory turnover, fixed assets turnover, total assets turnover, accounts receivable turnover, and average collection period. Profitability ratio measures management overall effectiveness as shown by returns generated on sales and investment. Gross profit margin, operating profit margin, net profit margin, return on total assets, return on stockholders' equity, earnings per share, price-earnings ratio. And last, growth ratios measures the firm's ability to maintain its economic positions in the growth of economy and industry. Sales, net income, earnings per share, and dividends per share. Financial analysis must go beyond the actual calculations and interpretations of ratios. The analysis should be conducted on three separate fronts. How has each ratio changed over time? How does each ratio compare to industry norms? Financial ratios are not without some limits. Financial ratios are based on accounting data, and firms differ in their treatment of such data. Second, seasonal factors can influence comparative ratios. Third, departures from industry averages do not always indicate that a firm is doing especially well or badly. Since consumer remains price sensitive, many firms have lowered price to compete. As a firm lower prices, its break-even point in terms of units sold increase. Notice that increasing fixed costs raises a firm's break-even quantity. Firms with fewer fixed costs have lower break-even points, which give them a decided advantage in harsh economic times. Firms must be cognizant of the fact that lowering prices and adding fixed could be particularly catastrophic. Penetration pricing is a strategy used by business to attract customers to a new product or services by offering a lower price initially. The lower price helps a new product or service penetrate the market and attracts customers away from competitors. Penetration pricing comes with the risk that new customers may choose the brand initially, but once prices increase, switch to a competitor. Elastic goods are the best types of goods for penetration pricing, as small changes in price often lead to large changes in demand. Notice that increasing fixed costs also raises a firm's break-even quantity. Firms with fewer fixed costs have lower break-even points, which give them a decided advantage in a harsh economic times. Firms must be cognizant of the fact that lowering prices and adding fixed costs could be particularly catastrophic. No company can totally avoid the impact of increasing costs, and most managers have learned to adjust to the effect inflation has on current operating costs, but few have factored it into their competitive strategies, and most managers, particularly those in capital-intensive industries, have not paid enough attention to the way increasing capital requirements affect their ability to compete in the long run.